He did it. My good friend Greg, he's now living off of dividends and passive income. He's a guest here on the channel today. This is part 2 of my exclusive video interview series with Greg. He is living the dream, so to speak. He went from working a job to now living full times off of dividends and passive income. Please congratulate Greg. Please welcome him back here on the channel to share his wisdom, the stocks that he owns, the passive income entities that he owns, the strategies that have worked for him. Please welcome him back and thank him for sharing all of this great content. Of course, part 1 of this exclusive video series, I will link to that in the description below and the pinned comment as well. Without further ado, please join me in congratulating Greg and welcoming him back here on PPCE and Dividend Stock Investing for Everyone. All right, Greg. So we've been talking about all these different investing opportunities like closed-end funds, BDCs, mortgage REITs, things I don't discuss myself here on this channel really at all. And so I would love to have your perspective here for people who are watching who haven't heard about these types of investments before, just what they're all about and just on very basic terms, what are these investments?
Mortgage REITs is a very controversial and misunderstood area of the market. They're like property REITs where they're required by law to pay out 90% of their earnings, but they trade more like income investments or financial institutions. And there's several types. There's commercial mREITs, there's residential mREITs, and then there's agency residential mREITs, the kind that are backed by Freddie and Fannie. I have experience with 2 of those out of the 3, and they're just another way to get it's a commercial mortgage REIT. To me, is not too radically different from an income closed-end fund. It just has a very specific type of entity that it's lending to, and it's easy to try. Not easy, but it's the same thing where you look at the portfolio quality, you look at the type of loans they give out, you look at their history, and there's so many of them that it comes back to what I said prior is I go to the people who are the most respected managers. And the one commercial mREIT I own, which is Acre, is also managed by Ares Management, who also manages my favorite BDC. So they kind of all stack nicely. And it's just one of those, it's a holding I added because they also have a lot of floating rate debt securities, which will do very well in this environment, and they're out earning their distribution right now. And good management they're the type that when you read what their reports and whatnot, it looks like that they're aware that there might be an economic slowdown, and they have the ability to weather it. So it's one of those that I'm not going to go out and buy a lot of mortgage REITs. In fact, I only own 3 really, and they're ancillary positions for sure. But it's something that I need, or I choose to involve with because it gives me the income I need to pay my bills. And so then there's also the more controversial ones, which are the agency residential REITs, which have not had a good 10-year history, and people really freak out over them. Yeah. But they're also they're hard to understand because they're counter-cyclical. They actually do better when there's a housing market is in a recession. And that's the one thing that people don't understand, because when the Federal Reserve was buying a lot of mortgage-backed securities in the past, during the past decade, they had a hard time making money because the spreads were not there. But now that the Fed is a net seller and no one else is buying them, it's their best environment ever. And so I believe that it's the beginning of a new upcycle for them because everything else is slowing. So that counter-cyclicality of them is very confusing. I'm not going to say I understand it perfectly, but then again, I'm relying on what I read. I'm relying on the testimony of people who understand it better, and I'm keeping it underweight in my portfolio. Those are all my hedges against uncertainty. And then there's also hybrid mortgage REITs, like one I own, Arbor Realty Trust. They're very much tied into residential real estate, which I believe, even though we're going into a slowdown, is in a secular. I mean, with the lack of building I don't think
Yes.
we'll ever get caught up. Personal belief.
Yes.
It's just it's going to be slow, but it's not like homes are going to go out of demand, and we're not going to have a repeat. I believe in any capacity of 0809. So an entity like Arbor, they have a very powerful 3-year history. They've had a dividend raise every quarter for
Wow.
like the past 3 years, and their current yield is about 11%. So you
Wow.
talk about yield on cost. That's one way to lock on a very powerful yield on cost. Your buddy, our mutual friend, Darth Dividend, who will probably be
Sure.
watching this video, that Arbor is one of his favorites. If you
Oh,
ever
all
watch,
right.
yep, yeah,
Nice.
he's
Shout
like,
out to Darth Dividend.
yeah. So he makes a lot of videos. So those are they're one of the more esoteric, probably one of the most esoteric parts of the market, and I write about them a lot. I try to tell people why I embrace those entities, why I need them to offset taxes and penalties and whatnot in my retirement accounts.
Hmm.
But I also tell people, don't, if you're not comfortable with this, just don't.
Yes.
It's not, if you don't understand, if you look at something like Annaly Capital and you say it's cut the dividend for 7 years, not realizing it's counter-cyclical, and now we're about to go reverse that, what I believe, then just don't participate in it. I'm just sharing uh the reasons why I involve myself with some of these entities. And
Hmm.
so that's one. Whereas I think if people can, uh mortgage REITs might be the last place to go, honestly. um BDCs, on the other hand, and closed-end funds are much less controversial because BDCs are much more well understood than mortgage REITs, and they have a much more stoic history, especially when you look at the best. When we talked about Main Street Capital, these companies that exist to lend money to the middle market, to companies who can't necessarily get loans from traditional banks, and the good ones can get both debt and equity stakes in those companies. So they can participate in more equity ups, or more economic upside than the ones that are pure debt or credit. And you can go on their websites, like you can go on Main Street Capital's website and look at the type of companies that it lends to, and the sectors and their history and all that. So they're probably a little bit easier to understand than the mortgage REITs for sure, which is why you see many more people buying BDCs in the community on Instagram than you do mortgage REITs. With the closed-end funds, those just come in handy. There's really two types, not just two types, but there's two that I focus on. You have the equity closed-end funds, like the ones from BlackRock that I've owned over the years, that where they buy baskets of stocks and then they try to pay out a distribution based on combination of the dividends they earn with some capital gains. And occasionally they also use leverage, and occasionally they also sell call options. And
Hmm.
all those are possible. You can have, usually you get one or more. Usually you have a fund that might use leverage or might use call options, but not always. I don't know of any. Well, they might use both. They typically use one. So that, in a sense, especially with the leverage, can create more volatility. But if you're using it to support a portfolio of other steady eddies, it can really come in handy, especially when you get that larger distribution. The one thing about in this environment, I have been focusing much more on credit closed-end funds and equity, because the credit funds are actually earning their distribution through net investment income, and that can be tracked. And you can see that the ones that are out earning their distribution, so you have much less of a fear of a cut, and actually more likely to get bonus. A lot of these credit closed-end funds and the BDCs as well, because of how similar they are actually paying out year-end distributions, because when they out earn, they have to give it back. That's their very structure, right? So that's one reason why I've been focusing a lot on the credit closed-end funds more, where as the equity closed-end funds, you do run the risk if we have a sideways market, or if the bear market lingers a little bit longer, you could see a distribution cut down the road, because they are bleeding out net asset value. And also, when they do pay out net asset value in a bear market, that just leaves less room to compound. So I become less enthused about those than I have the credit funds that are actually earning their all their distributions through net investment income. But that's something that when you get into reading about them, you can figure out their structure and what they own pretty easily.
Yeah. This is fabulous. I want to just, a lot of folks at home right now, I don't know if you're watching this or listening to it. I know there's a lot of people that just listen to these videos, but I encourage you all to watch as well, because I'm just taking in my own insights as Greg speaks and I'm writing them down, but also I'm trying to translate some of those insights on the bottom of the screen below us, because there's a lot of insights here. Just a few things I took away right here that I want to point out is I think it was so fabulous how, Greg, you mentioned that you don't have to participate in mortgage REITs if it doesn't feel right for you. I think all of us have different strategies. And the point of this interview, quite frankly, is to bring some new strategies to the channel that may or may not make sense for people watching. And so there are many different ways to reach financial freedom. And Greg is illustrating one way that could work. And it certainly has worked in his personal situation. So I liked that. I think something else that you said really resonated with me was the low housing stock. I know Greg hasn't said this, but I just happen to know this about him, that he's a very successful investor because he spends a lot of time reading and thinking and analyzing what's happening in our world. And just one of the statistics I have been following myself, I work in real estate, is that low housing stock. And it's happened, honestly, ever since that 2008 crisis. Back in that day, a lot of the home builders got way behind. Everything slowed to a halt. And they got so far behind building new homes that it's almost impossible for them to catch up. And that's a statistic I've seen over and over. So I thought it was resonated with me a lot that you mentioned that. A few other things as well, but I don't want to take away too much from getting your insights that are coming along here. But I just wanted to let the viewers know that I will share some of my own kind of key points and takeaways on the notes on the screen. But this is just fabulous. I wanted to go to another question. Greg, do you, and this is something interesting, actually, I already kind of know the answer, but I want to hear this because you're so good at explaining this and it's so different from what I do. Do you ever sell stocks? Do you become so attached to stocks that you have to like buy and hold forever? You can never sell it. It's painful to sell it, or are you okay selling a stock? And how do you look at selling stocks?
Yeah, I'm absolutely okay. I don't like to do it willy-nilly, and I definitely have non-quantitative reasons for holding. I think I may have mentioned earlier, I still keep my Pepsi and my P&G, even though they might not offer me the appreciation that I need. But I can certainly trim some if I feel like it's going to help me pay my bills better. There's no emotional attachment. Flat out liquidating positions I have done many times. I can think of when I was still working and I was buying up certain entities like Caterpillar. I was buying Caterpillar on sale in my 401k, and then 6 months later it had almost doubled, and it no longer had the yield I wanted it to do. And I think it's wherever I sold it is still higher than it is now, and that was probably a year ago, so it seemed like a good idea. And other things like Leggett and Platt I let go a long time ago because I just lost interest. And Lockheed Martin, I lost interest in that one as well after that popped off to the moon. And so there's definitely some things I don't want to, like, I don't ever, unless something forced necessity, I'd prefer not to liquidate my McDonald's or my Pepsi or my P&G or my J&J. Well, I guess with J&J, they're gonna split next year anyway, so it'll do me the favor of kind of turning into two companies itself. I don't have to worry about spreading the money around. But in some of it has to do not always with the company itself, had to do with the account I had it in. And so if I own a blue chip stock in my 401k and I've made a significant amount of capital appreciation, then I can lock in and turn that around and buy income. I am very likely to do so because, for one reason, I need it because I'm taking those 401k distributions every month. And there's no tax consequences for doing so because there's no paper trail until you take money out. Whereas in my personal account, I typically don't move money around as much, though I certainly have done so I think last year, maybe a little, maybe a little bit longer than a year, maybe 18 months. I cut my American Electric Power position in half because I had owned it for over a decade. I had had a 400 or 500% return just because it was a utility stock that bought it cheap and it grew 5, 6, 7, 8% a year. On top, I think my yield on cost on that one is like 14% or something
Nice.
crazy like that. And it was so huge, it was no longer didn't have the yield that it used to. So I took half of that, and then I bought a utility closed end fund, which owned more utilities and gave me more income, and that worked for me because I don't want to sit there and read about utility stocks. They're right up there with banks and pharmaceutical companies. I do not want to read about a utility company and what they do
Yeah.
because they all blur to me. Just like I don't want to read about the difference between a US bank, Fifth Third, and Bank of America. They will give me a headache. I don't even want to go there. So
Yeah.
that was a good thing that I did. I've cut my Microsoft position probably about 30 to 40%
Mm-hmm.
from
Mm-hmm.
peak to where it is now because I had my original purchase prices were in the high teens, in the low 20s, and now you know what it is. That's a lot
Yeah.
of capital gains
Yeah.
because I bought it when it was a value stock and not
Yeah.
taking it, not running the world. And so I
And
took
that's
that
still,
money and I built
sorry to cut you off. Is that still your largest position, Microsoft?
it is it sometimes it flirts with
Okay.
enterprise products partners.
Okay.
I have plans to take some of that Microsoft money and build new income securities with it. I've just been so busy
Yeah.
rebalancing in my Fidelity accounts that I haven't, or in my retirement accounts that I haven't worked on it yet, but it is on my list
Yeah.
of things to do. In a perfect world, I would love to see it back at 320, 330, and then liquidate some shares and buy some income. I don't think I'm going to get that opportunity anytime soon. And even if I were to do so, if the things that I want to buy go up the same rate, then it's a wash. It's a lateral move. But so it's a project that I'll be working on sometime before the end of the year. But
Okay.
it's whether that going forward, most likely enterprise products partners will be my largest stock position. I don't need Microsoft being my core holding anymore. And so it's the same reason I liquidated 3M is because I was getting frustrated with them
Mm-hmm.
and their recent, I think 2 years, you had anemic raises and for such a low yielding entity to start with. And it was in my Roth IRA. And I said, this is the opportunity cost was too high to keep it there when I could buy something like PDI or PDO, one of the PIMCO closed end funds, and get an 11, 12% yield and compound that. It was a no brainer. So 3M had to go. I think I'd be a lot more tolerant if I had a much larger dollar balance in my personal account. I might be a lot more tolerant with some of these companies that have these near-term issues or aren't necessarily giving the consistent growth. But when they're in certain accounts that I'm not putting money in anymore, I got to be a little more strict. And so I don't. It's never an emotional thing for me.
Mm-hmm.
It's just something I can't think if there's ever a time where I looked at a stock and I said, I just need you. I can't. I don't do that. They're all
Yeah.
there's some subjective value, non-quantitative value, qualitative value, but for me it comes down to the math at the end of the day, and I'm constantly playing with it until the distributions look the way that I want them to.
Yeah.
And so that's it's the same it's the same logic I use that I cut things like Merck and Amgen down by half, is because I just needed that money. I can't I can't have too much money tied up in something with a 3% yield, even if it might grow at an 8% clip. That's not, it's going to take me forever to get. When
Yeah.
I can buy BDCs that have an 11% distribution now that are going to give me an extra 4 or 5% at the end of the year. It's like,
Yeah.
but I don't necessarily want to liquidate them completely. So that's why I just do a little bit at a time until everything looks the way I want. And then I go from there. So I have no problem moving money around if it's a net positive for me and what I want in my life as far as cash flow.
That's interesting. And, I bring it back to a point you mentioned all the way at the beginning of the interview today. You were speaking about how each dollar, you kind of look at it as a soldier.
Every dollar's a soldier.
And it's the same kind of thing here. His dollars have grown, especially with a stock like Microsoft, where it has been not only profitable from a dividend and cash flow standpoint, but a capital appreciation has been phenomenal. I think, Greg, what you're saying is those dollars have multiplied, but they're all still soldiers. So you're trying to find the highest and best use for each dollar, each soldier in our current world right
Yep.
now to provide the cash flow that you need for your early fire that you're enjoying.
That's exactly right.
So I think that's really interesting. Now that you're in retirement, how do you manage cash flow? Is there any kind of, I know cash flow can be lumpy. It doesn't always come in, some of our stocks and investments, one of my favorites, Realty, it's the monthly dividend company, but they're
Yeah.
not all that way. Oftentimes the distributions are quarterly. And how do you manage that cash flow for yourself? Do you have any months where things are a little tighter, or months where things are easier? Do you have to kind of have almost a built-up buffer? How does that work?
They are lumpy to a certain degree. If you track a lot of the information I post on Instagram, they're not as lumpy as a lot of other people because I've worked hard at making it that way.
Mm.
And the fact that I've got so much into a lot of these closed end funds and other entities that pay monthly, I think close to 30 to 40% of my income I'd have to look actually is comes from monthly payers. So that's very, very powerful. And even when it is lumpy, it never really affects anything in my life because I'm going to go out and do what I want to do regardless of whether I'm getting the income now. That's a beautiful thing about the use of a credit card. You've got that 30-day float basically,
Yeah.
whereas you can buy something and you have that month to pay it off. And as long as you do that, it doesn't matter. And even if there's a few times where I haven't been able to get the cash flow out quite fast enough, and I've had a couple interest things on my credit card, but if I wake up and I see a $10 or $20 interest charge, it's
Mhm.
almost like a joke to me when some of my businesses are paying $200, $300, $400. It's
Yeah.
all it's all so when I do get some of that lumpiness, like when my pipelines pay out and I get a massive distribution in my personal account that I can take out immediately, and I get to keep all of that because there's no taxes in that account for those
Okay.
entities. It helps catch up. And it's I don't mind having a little bit of lag or latency with the cash flow compared to what I spend because I'm working on it all the time. I'm working on creating more cash flow,
Okay.
and the whole time without ever having any principal erosion because the same amount of assets are floating there. So it's the deal with it is I just go about my business. I don't obsess over it,
Okay.
and it doesn't really affect how I do anything. If I want to go out, if I want to do something, I'm going to go do it, and then I will figure out a way to pull out the income later.
Fabulous. And on that note, you were mentioning you're always kind of optimizing the portfolio and looking for ways to even increase the productivity of the portfolio. How are you going about that? Is it mainly taking a portion of the income and reinvesting it, or is it selling lower producing soldiers for higher producing soldiers? Are there any like side hustles you're pursuing to infuse more cash into the portfolio? How are you aiming to grow the portfolio?
It's the latter with the what you said with the selling the lower yielding ones with the delayed income, the more growthier entities to buy more current income is uh is how I do it. There is still some amount of dividend reinvestment. I do drip. I
Mhm.
currently have drip going on in my HSA because I don't want to touch that money. I currently have drip in my Roth IRA because that's my favorite account that I want to save. And I have not reached a point yet where I have enough 401k income to reinvest into that account specifically, because I'm pulling everything that I can out to use it. They might get that point in the future. It depends just how many of my classic core blue chip stocks I'm willing to nerf to get more income. It's one of those things that I won't know it till I get there.
Yeah.
And if I want to get there, I can go there. But there's just, I'm not to the point where I want to just completely go all in on income funds and get rid of some of the traditional high quality picks that I have in those accounts. So it's kind of I do want to reinvest, because definitely if I'm investing in more pass through entities where all the total return comes to you in income, and that distribution might stay the same for 10 years, you gotta reinvest a portion of that to keep up with inflation. You're not going to get that consistent growth that you might get out of the traditional blue chips. So there's a balancing act to that, and I'm doing the best I can, because I definitely want to see those numbers continue to rise. And if you were to chart my progress, if you were to look at some of my spreadsheets from even the last year to the beginning of this year to now, you can definitely see all the progress I've made from taking profits, taking a lot of the capital gains I've made in this market from entities that have not given, that are still trading at highs, and use that to buy things that are on sale. So
Yeah.
as far as the hustles, I haven't been motivated to pursue any of that in any capacity. It's
Nice.
just it's probably something that I'll have to address eventually, but this transition period where I'm just trying to get a feel of what to do with my time, it's not something that I really want to deal with right now. It
Fair
might be
enough.
something I want to deal with if I want a radical lifestyle upgrade, if I want to go out and buy a new sports car, or get a mansion, or get the beach house that I always talk about saving for. Then it might be, I might need a little hustle income or something on the side. But right now, I just can do the work I do in my accounts and have more than enough money to live. So
My next question, I feel like you may have already answered it. I wanted to ask if you've done anything to disaster proof your portfolio. And I think I already know part of your answer, at least, because you were foreshadowing that you've left yourself some options. You still have a lot of those lower yield or super premium blue chip names. Would you look at that as part of your disaster proofing strategy, that you're always thinking about what you could do if you needed more income, or what you could do in various scenarios? How do you look at that?
yeah, that is part of it. I look at them as a source of, maybe it's a position I don't want to liquidate completely now, but if the market were to tank really hard, and for some reason those entities were to stay high price to a relative degree, although if you get a severe enough capitulation, everything's going to come down. But it's just another source of funds that I can use to take advantage of whatever goes on sale. And disaster proofing for me also comes from competency, and it's being aware of how entities perform when they don't always have economic uh, tailwinds to prop them up. And that's a beautiful thing about a lot of these credit entities and things like BDCs. I think I mentioned this. You have things with credit where you're not betting on winning, you're just betting on treading water. So in a sense,
Yeah.
that is a form of disaster proofing. And it's like I said, some of these entities, I go back and look at their track record from the great financial crisis in 0809. I use that, make an inductive logic jump that if they probably will be able to deal with whatever comes in the future, if they were able to deal with most likely what was a generational uh, severe crisis. So that's, it's all forms of disaster proofing. Is one, having a dynamic mix of assets, like not going all in on something that's too risky or just a niche part of the market.
Mm-hmm.
And then understanding everything that you own, understanding how it's earning, understanding what could happen if the economy slows down. And then just another form of disaster proofing it ties back into what I said prior, is trying to overshoot
Mhm.
what I spend, because I have I have an extra cushion because I'm not even taking my Roth IRA distributions. Everything I own in there is going right back in what pays them. And
Nice.
if something were to happen, that's another source of income. And if something were to happen where I needed like emergency money, I might just sell a blue chip and just take the money out
Yeah.
and go back on business, because it's not going to be the end of the world for me, because that wasn't a primary source of income anyway, even if it's a large position. So
Yeah.
all those things are things I think about as far as disaster proofing, trying to stay ahead. And the cool thing again about this market is, even if we go into an economic slowdown next year, which by no means is guaranteed, we have no idea. It's going to be probably one of the weirdest economic slowdowns we've ever seen, where all the speculation and froth that was created from all the money printing, you can already see it. Tech's laying off hardcore. But I talked to my friends who still work in chemical and industrial. They're back.
Yes. Yeah.
They're so far behind. So it's a bifurcated economy, very much so. If I wanted to get a job at Kroger down the street right now, I probably could just walk in and get just
Absolutely.
it's two different worlds. And so I'm tethered to a lot of things that are going to function just fine, even if the world that has to give back all this excess speculation, all this nonsense that was created from mania, that's slowly deflating. And the great thing is, I never participated in that in the first place. I never got sucked into non-profitable tech companies or that other nonsense, or all the things that I thought were ridiculous at the time, that are giving back the things that are really hurting people right now.
Yeah.
The unprofitable
Yeah.
businesses
Yeah.
that never should have traded at the valuations, or valuations is a stretch of the word if they aren't even earning money. It's like I was never in that in the first place. And
Yeah.
that's where a lot of the pain is now, and where the pain will be going forward, is the unwinding leverage from all that stuff. And I never participated in it, so I have nothing to give back. And so that's another form of disaster proofing to me. And that's another thing that makes me feel good, is because everything I do is based on reality and math, and
Mhm.
not hype and nonsense, is what I would say. Nonsense. And some people might
Mhm.
not.
Greg, thank you for that great answer. And I just want to share with everyone at home. I was jotting some notes down, and I really like to hear from Greg because he has a more complex account structure. He has not only non-retirement accounts, but he has retirement accounts. And I think there's two things here. One, I've been looking at retirement accounts a little bit lately myself, just as a buffer. And so I thought it was interesting that it gives me options. It's kind of my disaster proofing. If by the time I'm ready to enter fire, I need a little extra money, or an unexpected expense comes up, that's one way I'm looking at my retirement accounts as well. So I thought it was really cool to hear about that. As part of your with the Roth in particular. And I also, though, wanted to state that I think it's interesting that you have achieved fire despite having to take distributions from retirement accounts before their traditional retirement age. And I
Mhm.
bet you there's a lot of people out there who may not even know that that's a possibility, because I think a lot of us think, hey, you have to wait. You have to wait till you're in your 60s, 65 to take distributions. And yes, there are ramifications and penalties for potentially for taking distributions younger. But I think, Greg, you're living proof of someone who has basically analyzed all of this, spreadsheeted it all, understand those ramifications, and have made the wisest possible decisions for your situation to use the cards that you have to live fire. So I think that's really neat. It's really neat to see. It's very different than what a lot of people would think, how someone would end up using a retirement account.
It's definitely, I wouldn't say it's ideal, but I've been asked before that, if I could go back and maybe put less. It gets into a very complicated math equation. I had a friend and I who were working on it, because even though I was putting money into those accounts, or maxing out my 401k in my 20s, that also reduced my tax bill that year. it also gave me a structure that allowed me to compound and move money around tax free, which I wouldn't have been able to have if I would have saved everything in a traditional account. So I don't necessarily know, I don't have the benefit of knowing what everything would be like had I not chose that path. And nor is it worth even thinking about, because that doesn't help me deal with what I have now. It's just focusing on maximizing the dollars that I have is way more effective than theory crafting. And that's why I get questions on Instagram. Where should I put my money? First thing, I never answer those because I don't want that responsibility. I'll tell people, you got to figure it out for yourself.
Yeah.
If, but it comes, a lot of it will have to do with some people. Some of it's a little bit common sensual, I think. People who work at an employer, and if they're at least getting a company match, it might be kind of foolish to at least not try to match it. And even if you're putting money in a target date fund or an index fund, you're still compounding, and you can convert that into passive income later. And then there's some people who are self-employed that have the SEP IRAs or whatever, the other accounts. I don't know, 403B maybe. I'm not an expert on any of those by any means. There are some people that might not even want to participate. They might just go exclusively taxable and Roth, and all that's fine. There's no right or wrong way to do it. It's not a binary situation. It's not black or white. It's all different degrees of efficacy based on your competency, what the options are, and what your goals are.
Yeah.
And it's just the most important thing is that people take ownership over their decisions. I clearly took ownership over mine.
Mm-hmm.
And now I created this system to deal with the decisions that I made. Whether or not they were the most ideal is something that we'll never know for sure.
Well, I think the conclusion to a lot of that as well is there are a world of opportunities out there. And I think sometimes it can get discouraging as an investor just starting out. It can get discouraging to think, well, is it possible even to reach financial independence? But, well, one, Greg is living proof that it is possible. But two, it seems to me through this conversation in particular that his strategy is a little different than mine. And so there's just a world of opportunity out there. It's so exciting to see that despite different structures of accounts, different types of investments, the public stock market and the passive income investments that are available out there provide so many opportunities. And on that note, I wanted just to ask you, Greg, do you have any thoughts or words of encouragement? There's probably some people just starting out who are like, wait a minute, this is possible. There's probably people who had a light bulb go off watching this interview, and they're thinking they might want to do the same. They might want to get started on that journey and find a way to retire early, find a way to sidestep that traditional job. Do you have any thoughts for anyone just starting out? Do you think it's still possible right now in 2022? Obviously, it's a lot further along than when you or I started in this investing game. Do you think there's still opportunities out there for people who are just starting?
Absolutely. I think it's never been easier for people who are starting. Not only do you have technology has made it to where you can do all this stuff on your phone. You live in an age where transaction costs are free. I remember when I started to buy a stock, it was about $15 a transaction. So having 30 stocks in a $20,000 portfolio would have been ridiculous because you had been destroyed by fees. Whereas now people sign up for these fintech companies like M1 that have these pie systems that let you own 100 stocks with a $10,000 balance, and they've made it's all easy. You can educate. The internet's out there. Digital subscriptions like I have, the Morningstar, Seeking Alpha, Barron's, they're all out there. YouTube's out there. The community's out there.
Yeah.
It's never been easier from an informational perspective for anybody who has the motivation to do so, to at least pursue some form of FIRE or passive income. And then it comes down to just scaling something to your competency. There's no need to even go all in individual stocks. I have plenty of friends that I've helped out where I just put them on, have them open an account and have them buy something like SCHD, the most popular
Yeah.
from my favorite broker, Schwab, have just one of the most popular dividend. I said, do this, put it all in there. Let them figure it out for you. You'll get there too. It's like there's no absolute right or wrong way to do it. And it's absolutely, you just have to have the habits. You have to have the self-control. You have to have the sense of delayed gratification. You have the ability to grind it out. So you need all that on top of a good work ethic, I would think, to
Yes.
get there, because you can't make something out of nothing. You need to have the initial seeds to plant to grow into the trees. But anybody who does have those, it has never been easier. I could only imagine if I could go back, if I could grow up now like I grew up in 2004 and 5, um, where I kind of had to figure everything out just by reading books, and there
Yeah.
wasn't a whole lot of information out there, and I was very much limited in what I could do based on the amount of assets that I had. Whereas today, there's fewer and fewer excuses. It's
Yeah.
never been better for in this market. Actually, I think is a net positive for people starting out, because it's stocks are cheaper now. They're probably not going to take off to the moon anytime soon, which means more people or have the opportunity to buy entities at a good price. You have so many people who were hurt by the last decade with a straight up market, and then it might have made them feel good making a $5,000 profit on their $5,000 account in a few years. But then I got to tell you, realize that's unsustainable. You're going to end up giving that back. You don't want those rallies when you're starting out. You want to invest when everything is down. You want to have your positions built down. You want it when there's less money in the system chasing everything.
Yeah.
And it's now starting now compared to like starting in 2010. I think it's going to be a tougher decade overall for a lot of investors, but it'll be better in the long run, because you might have, if we have like a lost decade again in equities for whatever reason, if we just have to give off more premium valuation and give up some of that froth and get that mean regression in there, it's a net positive for people who are buying. You do that, you look through history, any point in history, go back to my favorite period, like 68 to 82, and that secular bear market. You look at any history where there's been turmoil in the market or extended down period, and look at what happens if you're position building during those periods compared to starting at
Yeah.
a uptrend where you're buying higher and higher and higher. And then by the time you get your positions built, then you need the downtrend. That's not what anybody wants. But now, although there's still a lot of expensive entities in the equity market. I know we've already talked about some. There's still that are a lot of cheap right now. There are things that are on sale right now. There's bargains I've never seen in my life right now, and we may see more bargains next year. This might be a multi-year sideways market, which gives people who are position building time to scale and stack and collect a growing revenue stream. So I think it all works out. It should all work out for anyone who's starting, or even where somewhere in the middle of their journey, or even someone towards the end of their journey.
Yep.
Or not necessarily the end, but in the phases that we are, where we're
For
more
sure.
established and whatnot. It's working out well for everybody to have a market that's a little bit more sane.
Yeah.
It's a good environment. It's a great environment to start, and I only hope it stays that way. I hope we can keep funny money out of the system as long as we can, to where asset prices don't get inflated just because of funny money introduced in the system. So we'll see. But yeah, I think it's absolutely, I would encourage anybody who wants to start, just do it. Pick a broker. I have my favorites. I tend to run with the big boys over the fintech guys. I stick with Fidelity and Schwab. They're the two of the best in the world, best customer service. We'll never deal with Robinhood or anything like that, but that's just my personal preference. And so, I mean, that's You got to do that. Open an account, get started, educate yourself, and do the best you can. Learn from
Yes.
people who, it's like, just like I'm learning from people who are experts in niche areas of the market. There's just a stream of knowledge that just gets transferred. So it's all out there for anybody who wants to figure it out.
Well, Greg, that's very positive news. And I concur and agree with everything you just said. I love everything you said. And especially at the beginning of your point, I think back to when I started, and I've made every mistake in the book. And just the wealth of information that is out there now to hopefully avoid the next generation of investors from repeating mistakes of the past. And there's just so much great knowledge out there. And I'm excited about this market like you are as well. In my investing career, I've never seen anything like this in the bond market, that's for sure. And to your point, in the equity market as well, it's looking a lot better than it has in the past from many vantage points. So quite exciting. I just want to encourage everyone watching to please head on over and follow this man on Instagram. I will include a link in the description, in the pinned comment. Greg actually publishes his portfolio over there, so you can follow him in real time, what he's doing. It's amazing. He's got one of the best Instagram accounts for anyone who is investing for passive income. I want to please encourage all of you as well to head on to the comments below and just share your appreciation for Greg, and just give him a congratulations down there on behalf of the whole community and everyone watching. I just want to say congratulations, Greg, on your early retirement. That is amazing. Thank you for being a guest here again for the second time. I will link to the first video in the pinned comment below, in the description below. And I am so incredibly appreciative for you taking the time to share your journey with everyone here.
It's been a pleasure to share as well. I'm happy to have done this, and I would love to do it again sometime in the future.
Oh boy, that is would be amazing. And before we go, everyone, again, in terms of a disclosure, the stocks that Greg mentioned or I mentioned today, either he owns the stocks, I do, or both of us do. In terms of full disclosure, those are positions that are owned. And in terms of a disclaimer, today's video is not investment advice. Greg and I are just sharing our investing journeys here on YouTube for fun and entertainment. Please do speak with a licensed financial advisor before making any investment decisions. Just sharing our journeys here on YouTube. Thank you, everyone, for watching. Thank you, Greg. Huge congratulations. And we will catch you in the next dividend stock investing video. Wow, what a great interview. Thank you so much, Greg. I have a quick footnote I want to share today. This is something that Greg wanted me to put together, and it addresses a lot of the comments that we received on the last video, part 1 of this interview, about how Greg went ahead, left his job, and is now living full-time FIRE, financial independence, retire early. So in the video today, Greg discussed 4 different broad asset classes that he owns as part of his passive income portfolio. He owns those tried and true blue chip dividend stocks that I talk about all the time. He owns 3 different asset classes that he discussed today of high yielders. The first one he discussed was mortgage REITs, or mREITs. He also went on to discuss BDCs, or business development companies. And then he went on to discuss as well closed-end funds, or CEFs. There's actually a 4th tier of his high yielding strategy, and that includes covered call ETFs. And so I've discussed covered call ETFs here on my channel before. I used to own one. I went ahead and sold it. It didn't perform quite as I had expected during the down market, and it was a covered call ETF, probably in the context of all the covered call ETFs, that isn't one of the most exciting ones. Well, Greg actually happens to own one of the more exciting covered call ETFs that a lot of investors in the broader passive income community talk about. It's called JEPI, JEPI, and that stands for the JP Morgan Equity Premium income ETF. Now, the way JEPI works, to my understanding, is the analysts at the mutual fund or the exchange traded fund, they perform fundamental research on quality core stocks, much like I do on my blue chip dividend stocks, and then they select stocks for the portfolio. On top of that, they sell covered calls against the S&P 500, and they do that to generate income, monthly income that can be distributed to the ETF holders. And so Greg wanted me to share with all of you that he does own JEPI. It's part of his high yield strategy. It's just another pillar in his strategy, if you will, and that is a covered call ETF that he owns. And it's important to mention out in a video talking about high yielding strategies, passive income, that there is another segment of opportunities out there under the umbrella of covered call ETFs. Now, it is important to mention that not all covered call ETFs are created equally. Not all of them have the same strategy. Not all of them perform quite as well as the others. I'm proof of that I owned one and I sold it. It didn't perform as I had expected. But JEPI is one that is generally regarded in the passive income community as a solid performer, but it's important in general. This is not investment advice. We're not providing investment advice, just sharing our journeys here on YouTube today. It's important that the investor at home performs research and selects the right covered call ETF if that is a strategy that's interesting to the investor at hand for that investor. And so it is a segment of investments that does require analysis, and not all of the covered call ETFs are created equally. And so I hope that helps provide a little bit of a footnote, a little bit of context that yes, Greg does own JEPI as well. And with that, I have a closing segment of the video today that I am going to share with all of you right now. All right, everyone, I truly hope you enjoyed the video today. This is part 2 of my video series with Greg. Make sure to check out the pinned comment below, the description below, to check out part 1. Boy, Greg, congratulations. If you enjoyed the video today, by the way, please go ahead and click the like button. It means the world to me, but it also shows Greg your support for him being here on the channel. And don't forget to comment below as well with your words of congratulations and also any questions you might have for Greg. And by the way, I actually interviewed Greg just over a year ago before he retired, so check out the pinned comment in the description below. I will link to that video as well. So I now have 3 videos with Greg. Greg, thank you so much for sharing your wisdom here with all of us. It has been such a fun process, and I can't wait until next time. And all of you who want to follow Greg, follow his journey, see his portfolio, see his passive income, follow what he's doing, he is on Instagram. He is the Dividend Monster. I will link to his Instagram in the pinned comment. Go ahead and check him out on Instagram. He shares a world of knowledge over on Instagram. Before I leave today, I do want to share a disclosure and a disclaimer. In terms of a disclaimer, this disclaimer covers both myself and Greg. In terms of a disclaimer, we are not offering financial advice. We are not licensed investment advisors. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market, bond market, credit markets, anywhere, please go ahead and consult your licensed financial advisor first. Greg and I are just sharing our journeys here on YouTube for fun and entertainment. It's possible to lose money in the markets. This is not investment advice. Also, in terms of a full disclosure, I want to list the stocks and entities that were covered in the video. Either I own it, Greg owns it, or both of us own it. So in terms of full disclosure, the entities covered are as follows: PepsiCo, PEP, Procter Gamble, PG, Caterpillar, CAT, Leggett and Platt, LEG, McDonald's, MCD, Johnson & Johnson, J&J, American Electric Power Company, AEP, Microsoft, MSFT, 3M, MMM, also Merck, MRK, Amgen, AMGN, Realty Income, ticker O. I've got a few more. Ares Commercial Real Estate Corporation, ACRE, Arbor Realty Trust, ABR. I've also got Annaly Capital Management, NLY, Main Street Capital Corporation, MAIN, Enterprise Products Partners, LP, EPD. I've also got the PIMCO Dynamic Income Fund, PDI, and the PIMCO Dynamic Income Opportunities Fund, PDO. Again, either Greg owns it, I own it, or both of us own it in terms of full disclosure. Thank you so much for being here today. I hope you enjoyed the video. I hope you enjoyed the interview. Thank you again, Greg. We will see you all in the comment section below.